While investors prepare for hopefully another strong July ahead, focus still remains on the Fed and the path ahead for the second half of the year. And joining us now is Jim Smigiel, SEI Chief Investment Officer. Jim, great to see you.
Good to see you again, Josh. Shauna?
So we had maybe some big picture, Jim. We had, obviously strong first half.
Yep.
What are you telling your clients? Do you think the good times continue? Do we repeat this in the second half?
We're definitely letting them know that we think the economy has been much, much more resilient than we had expected. But we also are having them prepare for higher interest rates. We're seeing that today. This has been two pretty strong days. Obviously, a lot of that based maybe on the outcome of the last debate and what that portends for November. But our view has kind of always been, and this has been one of our biggest tactical positions this year, has been for higher 10-year rates. I mean, we see inflation being stickier than expectations. The Fed wants to cut. There's no doubt about that, whether or not they should or not, but we think we're only going to get one this year. And we think the 10-year does continue to drift, even drift back up to that 5% level. The bigger news last week, maybe even from a debt perspective, outside of the debate, was really the CBO report. So, we're going to add $400 billion to the debt. Since the February estimate, we're looking at 122% debt to GDP in the next 10 years, interest costs overtaking defense spending. The picture is not a pretty one, and supply and demand at some point is going to matter in the Treasury market.
Jim, when you talk about getting back potentially up to that 5% level, what does that timeline look like? How quickly do you think we could reapproach those levels?
We wouldn't be surprised to see that as we approach the end of the year. So the one wild card here is, what will the Fed do? We think we don't have enough time between now and July. July is off the table, and September might just be a little too close to the election. So again, they want to cut. Whether or not the data is going to allow them to do that remains to be seen. We'll get another picture of that this coming Friday with NFP. But this bear steepening that we've seen in the curve is something that we expect to continue. So this could definitely be, by the fourth quarter of this year, we're going to test those levels again.
Let me ask you, Jim, another earnings season fast approaching here, right? I'm just curious to get your take. When you look at earnings expectations, do they look achievable to you, Jim? Do they look lofty? How do you think about it?
I'll take the latter. They look a bit lofty, very optimistic. I think earnings season is going to be interesting from not necessarily do companies hit their numbers, but how they hit their numbers. Are we talking about, is this micromanagement? Is this expense management and buybacks to get to this number that the street has put on each individual company? Or are we actually seeing kind of organic growth? And outside of all that, we're really more interested in guidance than we are in kind of the earnings. Like how are companies seeing the next kind of 6 months of the year? How are they preparing? What do they see the economy on that kind of day-to-day basis? What does that mean for the consumer? What does that mean for the business environment? That's going to be the most interesting thing. But the bar is high. The bar is particularly high in mega tech. I mean, that's where it's very, very lofty.
So, Jim, my question to you, if you see yields potentially, the 10-year yield heading back to 5%, you talk about valuations right now, maybe some concerning trends just in terms of how high that bar is here for this upcoming earnings season. Where does that leave us with equities? And I guess how much volatility should investors then be bracing for? Well,
it's interesting because volatility is the key metric here. Index level volatility has been incredibly low.
Yeah.
We've been looking at 11 handles not that long ago, so a little bit higher today. Individual stock volatility, of course, is always going to be higher than the index level, but what's so unique is how high it is with the largest names in the index. If you look at the implied volatility of NVIDIA, it's over 50. I mean, that is a really highly volatile name that just happens to be one of the largest companies in the entire world. So our view and what we're telling investors is pretty basic at the end of the day, which is diversify away. Particularly if you're a passive investor, it's worth remembering you're a buyer at any price, and about 35 cents of every dollar you put into the market is going into 10 names. And thinking about that in a different way, maybe adding some active management, adding some differentiated beta approaches, equal weights or value indices, not a bad time to be doing that, to kind of take some chips off the table with this very, very concentrated U.S. large cap market.
And Jim, you also, earlier you mentioned the presidential debate. I just want to get your take on, obviously, listen, we had the debate.
Yep.
Today we had the Supreme Court decision. How are you talking about this election to your clients? What kind of questions are you getting, and what are your answers?
Yeah, I think all of us in this business, when we talk about things like politics, we like to speak lightly. But so no doubt, look, the betting markets are what they are. We're pricing in a higher probability of not just a win for former President Trump, but really a Republican sweep. So now you're going to get tax cuts, you're going to get tariffs. What does that mean from an inflationary perspective? The one thing that we are reminding our investors of is that one way in which it doesn't really matter is the debt, right? No one's talking about fiscal responsibility. No one's talking about entitlement reform. So however we get to an increased debt level, whether it's through tax cuts or whether it's through additional spending, the reality is we're going to be looking at still a deluge of government debt coming down the pike. That's not changing regardless of what happens in November.
So then what does that mean for the economy? What does that mean then more broadly speaking for the markets given that risk that appears to be an overhang?
We think it means a higher than what investors are used to terminal rate from the Federal Reserve, kind of a higher inflation rate than what investors have been used to in recent years. So that in our minds, that kind of plays into this kind of higher for longer type scenario. Because again, supply and demand does matter, and we're going to have a lot of supply. Whether or not all the same buyers are going to be there for the Treasury market kind of remains to be seen. We're skeptical of that.
All right, Jim, great to have you on set. Thanks for helping us kick off the show.
Thanks for having me.
Appreciate it.